And we're back.
It is about time.
It's been a while since we've done the last episode.
Like a year?
I think a little more.
A little more than a year? Okay, well, we're back.
And we're excited that we're more focused now on what we're doing as far as a company and what we're investing in, and we're ready to share that to our friends, our family, our audience, and just spread the word.
Yeah, I'm pretty excited. I think this is going to be a lot more purposeful, and over the last year, we've learned a lot and have grown a lot as a company, and so want to share that with everybody that's following along and hopefully provide value to everyone looking to invest in real estate. So you want to get jamming?
Let's get right to it. So what we've been doing a lot over the last year specifically is purchasing single-family homes and making that our main driver in what we're purchasing and operating. And I guess I'd lean on you on why are we doing that? It's not very sexy. Single-family homes aren't seen as people think about skyscrapers. They think about building apartments, and we're doing single-family homes. And why are we doing that?
Good question. So, kind of going to where we see the most opportunity. Our whole investment thesis is based around the fact that we think single-family homes are an undervalued asset class currently in today's market, which a lot of areas feel overvalued. And so single-family homes gives us an opportunity to continue to invest in real estate, but invest in a way that we feel has pretty safe risk-adjusted returns. So we're always looking to protect our downside, and I think single-family homes provide that a lot more than some of the other asset classes out there currently. And one of the cool things, and the whole reason we brought back the podcast, is to talk to people, because the strategy that we're implementing can be done by any professional that has a job, that has a W-2 income, and can start building wealth through real estate following much of the same strategy.
So based on that, what are we doing? I mean, how many deals are we buying, right? It's easy to say we're buying single-family homes. What is our target number of properties that we want to purchase? How are we purchasing it? How are we structuring it to make it, talk about exactly what you're doing to have a competitive advantage?
Yeah, so we have a single-family investment fund. So we raise capital from private investors and are acquiring anywhere between about 5 and 7 homes a month. We're purchasing them cash. So we go out, we're able to write competitive offers, cash offers, and then after we assemble anywhere between 40 and 60 homes, we go out to institutional lenders and find a bank that wants to lend on our portfolio. So we find a portfolio lender and refinance. And during this acquisition period, we're improving the properties, we're increasing the value, and then when we do that refinance, we're aiming to pull out anywhere between 70 to 80% of our equity. We return that back to our investors, and then over the next 5 to 7 years, we're sitting on a pool of 50 to 60 single-family homes.
So people might see debt as a bad thing. Why, and pros and cons to both. Why is refinancing it? Why is that one of the strategies that we're doing?
Yeah, so for us, capital, the cash is a limited resource. And so being able to refinance and do it in a way that we feel is relatively secure. I know I said 70 to 80% of our equity back, but we're really taking about 60% of loan to value. So the properties have appreciated. So our debt to value is about 60%. So we feel that's pretty secure. We can make our interest payments, and it drastically increases our returns.
How do you think, so when you talk about a portfolio of 40 to 60 homes, that's a lot of single-family homes and spread across, at least in Tucson, a whole city. Mm-hmm. How strategic, and how are we operating these houses to make sure that we, don't have a bunch of maintenance, right? That we don't have tenants that are just trashing the homes, and they can be a risk. How are we ensuring that we're operating them very professionally and getting the rental return?
Yeah, so, Apex started and was founded on providing third-party services for owners of single-family homes doing property management and construction. And so that's kind of our backbone. That's our core competency as a business. And so we've taken that and have really built those companies to provide value to the investments. So our management team has I think we're doing some of the best marketing in the single family space in Tucson. That shows in the fact that we're leasing as quick as we are. Our maintenance and construction teams are getting in and getting out very, very quick on the projects that we're doing. And so there are a lot of challenges to it. I think the nice thing is we've kind of found a niche where our operating businesses align very well with our investment strategy.
Mm-hmm. So, and I mean, you just talked about how well we're marketing property. We want to talk about a few deals later on in the segment of deals that we're buying or have bought recently, and just go over the numbers with you so you guys can analyze it along with us. One of them we closed on last week. I think, what was it, last Friday?
Friday, yep.
We had it marketed the next day, and we already have a lease going out on it.
Yeah, the lease went out today.
So that's crazy.
When you get purposeful and you kind of find what you want to be the best in the world at, it's a lot easier to put systems in place. And so we have a full team now. The second it closed, the keys were in our office. The second the keys were in our office, the locksmith was being called to change the locks, and the property manager was being notified to get marketing photos. Our leasing agent had the marketing up once the photos came in and on the market and was showing the property. So you can streamline those systems as long as you're going an inch wide and a mile deep and really finding your niche.
Mm-hmm. Do you want to talk about deals now?
Yeah. Do you want to talk about why you should invest in single family homes first?
Actually, yeah. Let's do that first. So, yeah. I mean, like we talked about before, single families are not sexy. It's where people maybe start, but the end goal most of the time of people that we'll talk to is, I want to build. I want to own a 50-unit apartment complex. I want to do this. I want to do that. And again, we're diving very deep on single family homes, and why are we doing that?
Yeah, I mean, there's a couple different reasons why we feel that they're a sound investment. I think one of the biggest in Tucson and the country as a whole, in most markets, affordability is becoming a huge issue for renters and for homeowners. And so our target kind of home, and we're going to talk about a couple deals today, is in a $140,000 to $180,000 price point. That equates to a rent of $1,100 to $1,400 a month. That's kind of right in that mix of affordability. And you can't really build a home with today's cost of construction, a 3-bed, 2-bath for under $220,000. Mm-hmm. And so it's going to be very hard for new competition to enter and compete at that price point. And so we feel there's some very good barriers to entry. We have a moat around that business, if you will. Which ultimately we feel can lead to some pretty awesome appreciation over time, both on the rental side and on the value of the property. So if I'm buying a home for $150,000 and we see 6-7% home value appreciation in the Tucson market over the next couple of years, that's going to really, really increase our overall returns on that investment. When you look at another reason that we really like it is the consistent cash flow. So these single family homes are producing anywhere between a 6 to 7% return, right? Cap rate. So after all your expenses and this is with cash, for our cash investment, we're seeing 6 to 7%. There's not many fixed income products out there that provide that type of yield. And so it's great cash flow in the short term and positioned very well for appreciation and asset class that we see the demand increasing. So, that's kind of a long answer. Basically, we feel we can buy homes below replacement cost and have a rental pool that is growing and have a barrier to entry from others who want to come in and say, hey, I want to build a house and rent it for $1,200 a month. Good luck. It's really hard to do right now. I don't think you can do it and make those numbers work. So that's why we like single family.
I remember a year ago when we met and we were looking at just numbers for Tucson, you identified that the rent to income ratio was extremely lower than nationwide. And we saw you saw that was going to be appreciating. And we're seeing it right now with our rentals. When we started this, we're like maybe $1,200 a month for a 3-2. And now we're $1,300 a month pretty easily. And it's starting to creep up as the days go on, as we're recording this podcast. And, it's just very interesting to see.
Yeah, I mean, you have our local market, right? And so you can speak to that, but you also have, we're coming out of COVID, we're coming out of the federal government trying to stimulate the economy and inject a lot of liquidity, a lot of capital into the economy. Well, odds are that's going to result in some pretty substantial inflation. And so a great hedge against that is owning real property. And so that's another aspect of this investment strategy. So we think we're positioned well in our market in Tucson, where we should have appreciation just because our rent to income is well below the national average.
Yeah.
National average is 30% of a tenant's monthly income typically goes to rent. I think we're at like 22% in Tucson right now. Mm-hmm. So we still have some runway there. And then on top of that, you compound that with inflation. Seems like that's pretty likely over the next 5 years. Nobody has a crystal ball, but the people that I respect and listen to all tend to lean towards that belief. And so we're positioned well in this market for reaping the benefits of having hard assets.
So in your opinion, why should someone that maybe has $50,000 sitting around that wants to get into real estate, why would you pitch them on? Obviously, we've been talking about the great things about single families, but why is putting that $50,000 towards a conventional loan, especially in today's age with where interest rates are at? Why is that could be seen as a very safe investment?
Yeah. Well, I think the biggest thing that anyone that has a decent job, decent income, and $50,000 to invest, the thing that individual has is the ability to get a very low interest rate mortgage. A Fannie or Freddie loan that is backed by the federal government results in very low interest rates. And being able to capitalize on that, when your interest rate is 4% and your property is yielding 6 or 7, that spread on your debt is going to be a substantial increase to your cash on cash return. So I take my $50,000, I go to the bank and I borrow $200,000. I now have $250,000, and with that I can purchase an asset that should deliver 6 to 7% return. Well, I have to pay the bank, 4% on my loan. The additional 3% there is just going to go into my pocket. And so that ability to have leverage, and debt is risky. I'm not saying over leverage. I'm saying go out and take on 5 or 6 of these loans. But if you can survive and invest safely, where if it's not rented or if there's a major repair, you can cover that, and you can deploy capital into the single family space and buy 1 or 2 homes with traditional mortgages, I think you have a great opportunity for upside appreciation in the property as well as cash flow.
When someone thinks about buying a single-family house, they probably think about managing it.
Sure.
Right. So if you're a first-time investor, if you're starting all over again, and even to myself with the properties that I have, do you recommend property management and leveraging that out, or do you recommend just grind it out and manage the property?
Yeah. I mean, I think the answer is it depends.
Yep.
Everybody's situation is different. If you are working 80 hours a week in a very high-paying job, it doesn't make sense to worry about a tenant phone call. But if you maybe have a little extra time, maybe you're retired and you got some time anyway, then being really hands-on with your property and getting to know the tenants and caring for it, it's a substantial investment. So the more hands-on you can be, the better. But I think for people who don't understand that you can find a good property manager, and in Tucson, it's not just Apex in Tucson. There's a couple really good management companies. You find a good property manager that you trust and you pay them well to manage your property. That allows you to be completely hands-off and passive, but still reap the benefits of investing in real estate.
How do you know by asking a few questions whether they're a good manager or not?
I think Google reviews is a great place to start. I think getting to know their portfolio, getting some addresses and driving by the properties, that's probably a very good indicator. Are they well maintained? Do they take good care of their properties? And then just how they handle different tenant interactions. How do you handle the leasing? Look at some of their lists, other properties that they marketed on Zillow or on other sites. Are they good marketing photos or not? Call their office. See if somebody answers. Are they responsive? In property management, it's all about being responsive and just kind of delivering on what you say you're going to do. You should have good marketing photos. You should respond to tenants' requests for work orders and maintenance. And if you do those things, you're going to be successful.
Yeah, it's good stuff. All right, you ready?
Yeah, you want to talk about some deals?
Yeah, let's talk about some deals. So if you are listening to the podcast right now, maybe on iTunes or Spotify, we are going to do a walkthrough on Microsoft Excel of these deals that we're doing, and we're not going to explain everything to the detail. We're going to go kind of quick through them. If you have any questions, you can reach out to us. But you'll be able to go to the YouTube video and look at the pictures of the property, and then look at the analysis. But we'll also talk about it out loud if you don't want to do that. So just letting you know.
Yeah, and we're trying to use deals. So these are deals that we have either purchased or in the process of purchasing, and they're deals that a typical first-time investor have access to. So we're not trying to go out and show you our home run deals that come along once every 3 years and show you these amazing returns. These are just standard deals that are out there and kind of how we look at them and view the numbers. So looking at this 1974 Avenida how do you say it? Planeta. Thank you, Scott. Just kind of go through the photos real fast. You want to talk through this?
Yeah, I mean, it listed on the market. So, I mean, we obviously, I'm on the acquisitions team. I'm looking at all the deals and underwriting them before they go to everyone else in our company. And this one slid across my desk. And the way I looked at it is it's a turnkey, 3-bedroom, 2-bath, good square footage. It has an HVAC unit. It has good landscaping. Those things that families enjoy. They want to be able to put their dog in the backyard. They want to have a yard for their kids to play in, and it's in a good area. An area that we've had successful renting in previously, and when it fits that criteria, I know that it's probably an interesting one to look at and to move forward on.
Yeah, and so this came on the market, and you saw the opportunity. We submitted an offer. How many offers did they have?
They had 8 offers, I think, within 24 hours.
24 hours.
So they started it at $160,000, and we ended up getting it under contract we got it under contract at $165,000. So you might think that that's not an amazing deal, but there's value there. They had offers, north of $170,000 for this, and obviously with us coming in with cash and a convenient sale, there's value there for a reduction in price. But so we locked it up at $165,000, and we went to do our due diligence. Found little things like we're going to have to repaint certain rooms and certain things like that. The fascia is going to have to be redone, and we're able to negotiate another $2,000 down with the seller. So.
And we kind of look at this. We think fair market value is probably 175, 180, based on the demand that they had received quickly. So our cash offer, 165. We're now at 163. Renovation cost projected is right around.
I think it was 3 to 4, maybe.
Yeah. So we're going to throw in 4,000.
And what were we going to do? Again, address the things that we got the price down on. It's going to give us some paint. It's going to reduce some fascia stuff and just general cleanup of this property to market it.
Yep.
Like an awesome property.
So our total investment, if you're following along, you can see here it's $167,000, and I want to zoom in a little bit just to make it. Mm-hmm. So total investment $167,000. Our projected rent on this property is $1,350 a month, and that's based on our experience in the current market with how fast our 3-bed, 2-baths are moving. We're seeing a huge demand, 3-bed, 2-bath homes. Just because they appeal to so many different types of prospective renters. So our monthly rent is $1,350. Now, Scott, talk to me a little bit. I'm an investor. How do I take this monthly rent and how much I invested and grind all the gears and pop out my cap rate? And maybe start with what is a cap rate?
Yeah, so a cap rate is essentially the return that you're getting on the overall purchase of the property, right? And so if I'm running the numbers, it's very simple if you think about it. You're taking your monthly rent and you times it by 12, right? You can get $1,350 for a year. So you're $1,350 times 12. You're going to take that amount and you're going to times it by 0.65. You're assuming with this single-family home with taxes, insurance, maybe little utility fees on the transfer of the utilities, repairs, your income's going to be hit around 35%. So towards that expenses. So if you're looking at the sheet right now, you have an expense multiple of about 35%.
And just real quick for anybody following along, I just took the monthly expense times 1 minus the expense multiple, which equates to the same 65%. Now in this expense multiple, it's important to kind of understand what does that encompass. That's basically everything that you are going to occur as the homeowner or as the investor that owns this property. So that's your property management, that's your insurance, That's your basic repairs. What else do I have in there? I'm missing one big one. Property taxes. And then a vacancy factor. And we kind of just jumble all this together to get a quick down and dirty. What are we anticipating to make yearly on this property? So our yearly income comes out to $10,530.
And with that expense multiple, I mean, as we're running these numbers, if you're moving further along on a deal, you actually want to get more concrete rather than just crossing your fingers on that 35% expense. You might be in a really great area. Well, really great areas usually mean higher property taxes. So it can ebb and flow differently. Vice versa, you could be in a not as nice neighborhood, and your repairs might need to be a little higher than one that's in a nicer area. So that can fluctuate.
Yeah, and so on this property, it's in pretty good shape. We walked through with our head of construction, Rob, and it looks like everything's going to last for the next 5 to 10 years. So with a 35% expense multiple, we feel pretty comfortable. About 10% of that is going to repairs and maintenance, and that seems to be in line for this particular property. So you can see here our cap rate, which is just our yearly income divided by our total investment. Our cap rate is 6.3%. Now, there's a couple things to understand, think about, recognize here. This cap rate, that's going to be that is our full total investment or our yearly income divided by our total investment. There are, for a normal investor, you're going to be able to bring on a traditional mortgage. So your total investment, your out-of-pocket investment, is going to be substantially lower than that $167,000. What that ultimately means is your cap rate or your cash-on-cash return is going to be much higher.
Are you able to run that on the sheet?
I can kind of ballpark it.
Yeah.
So let's say my loan is going to be 80%. Mm-hmm. So I would do...
So that means as when you're buying this property, you're going to come in with 20% of the purchase price. So it would be 20% of 163 in this situation.
And that should be when a dollar sign there. Okay, so my loan is $130,000. Mm-hmm. My investment equals this, my purchase price minus my loan plus any renovation costs that I have to put into the property.
Yep.
And we actually have an Excel deal sheet for anybody that wants to use this as a template. We've built one out completely.
Yeah.
I think putting it together and talking through it actually helps because you can see where all the numbers are plugging in. So you can see here, our loan is $130,000. Our investment is $36,000. So let's say right now, what's a conventional mortgage interest rate?
I mean, I'm seeing crazy ones. I would just 4.2% maybe, conservatively.
So 4.2% is going to be the interest paid yearly on the mortgage. So if I take my loan, multiply by 4.2%, right? Mm-hmm. That's my interest expense for the year. Now, when you look at a mortgage statement, you have your interest expense and then you have this impound account. And the impound account is going to be your property taxes and your insurance. We've already factored those in up here with this expense multiple. So those wouldn't come into play here as we're running our numbers. We've kind of already considered that cost up above. So now if I have this mortgage, that means I'm paying interest. My yearly income is going to go down. So my net income is going to be my yearly income minus my interest expense. So now I've gone from making $10,500 a year down to $5,000 a year. However, instead of investing $167,000, I've only invested $36,000. So now my cash on cash return is going to be this net income divided by my total investment. That starts to look a little bit more attractive, right? 14%, 13.5%, 13.8%. Okay, so now we're talking. Now I'm feeling a little bit better about, okay, I buy a property, I can make 13% a year. That's awesome. Well, there's one last piece that has to be considered in here, and this is kind of the wild card. You never know, is home prices going up? Are they going down? You know, so many people still remember the pain that was felt in 2008 to 2012 and all the wealth that was lost through those home values just decreasing so much in value. However, historically, homes appreciate at
Depends on the market, but around 4.5.
What's the national average?
It's around there.
Yeah.
4.7.
So I think he's a little optimistic there. I think it's more like 3, kind of
Okay.
closer to inflation. So, but home values typically follow and kind of the national inflation average as well. So when we look at the home valuation and we're talking about maybe moving into an inflationary period, I think it's reasonable to assume at least 3% value a year, right? You feel good about that?
I feel good.
I'm going to use 3%. So basically what we're saying is every year that we own this property, it's going to increase in value by about 3%. Mm-hmm. So appreciation is going to be per year times 0.03. Do that right? Looks good.
I think so. Yeah.
Okay, so we're saying our home is going to appreciate 3% a year.
This isn't even counting the 170 to 180 that we think it's worth now. So
Correct.
keep that in mind. So we think it's worth a little bit more, but we're just going to run these numbers.
Yep, that's a very good point. So we already have some equity built in, but let's just say, maybe it's a little bit less appreciation, takes a little bit longer for that value to be recognized. And this is a compounding element as well. So any of the people who are really good at math are saying, well, this should compound and grow. Understood. I want to just keep this as simple as possible. So our appreciation, when we sell this property, we will reap the benefits of that appreciation, right? We're going to sell it ideally for more than we paid for it. So if you factor in your appreciation into your income, and what should we call this? Just total return? I'm running out of acronyms.
That's fine.
Total return is going to be our net income plus our yearly appreciation. Now we're back to $9,943 a month. If you take our cash on cash with appreciation, and you take our total return and divide it by our total investment, you're at 27%. So again, that's the value of having access to these federally backed mortgages, getting a conventional loan, and how you can utilize that to really make it work for you and take a $40,000 investment and have it grow substantially. I mean, are you happy with 27%?
I mean, the other thing I'm thinking about too is principal pay down as well. That
It's kind of
it's in there, but it's like when you look at a property that it seems like we're buying it at market value, we went to purchase it above what they were asking for. It doesn't seem that awesome, but when you can break it down and look at the numbers, it's astonishing.
Yeah, and it goes, this is kind of assuming that things go well. There are things that could go wrong here. You could have vacancy. You could have a tenant trash your property. I mean, you don't want to go into an investment and go, I can make 27% and nothing's going to go wrong. That's not really that realistic to go into it thinking that way. However, when you look at what is the downside if a tenant trashes the property and you have to fix it up, what is the downside if I have some vacancy versus what is the upside if Tucson continues to appreciate at 5% or 6% a year? And we as a company kind of tend to believe that that's going to happen over the next couple of years. The growth in Tucson, especially at this price point, and the continually increasing demand of affordability. 6%, if you change this appreciation to 6% from 3%, which is what we had last year and the year before, Tucson was one of the most appreciating markets in the country. All of a sudden, you're at 41%.
Hey there. So unfortunately, we did have a technical difficulty. Both our camera actually stopped recording. So unfortunately, we had to stop it. What's most embarrassing of it all is Ben and I went on to talk for probably another 15 minutes beyond that, just discussing the deal a little bit further. So obviously, this is our first one with the reboot of ROI, and we're going to make sure it doesn't happen again. But it just goes, if you watch that video and the deal that we ran through, just a typical deal that you can find in our local market right now is you can, if appreciation stays the same and the numbers pretty much average out to what the rest of our portfolio is performing at, is you can turn a deal that you're paying over asking price into a 27% to a 41% cash on cash return when you introduce leverage. So again, these are deals that you can do, and we want to help you accomplish it. If you are looking to get into real estate and to buy investment property, we are happy to review deals here locally if you find it. as well as if you're in another market and you want us to review and underwrite that deal for you, just to give you our 2 cents and just to see what we think about it. Give us a call, shoot us an email. We'll have the information right here, and we look forward to working with you. Look out for the next episode here shortly. We hope you guys enjoy this format. If you have any recommendation, if you have any little adjustments you want to make to recommend to us, we are happy and willing to make those changes. I know it's a little bit different format, but just let us know. Thank you again for tuning in, and we'll see you next time. See ya.